This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the fourth Friday of January 2016. In the economy, the number of applications for unemployment increased to a 6-week high last week. Plunging oil prices may mean more cuts in the labor market as energy companies reconsider headcounts. The Federal Reserve meeting begins this upcoming Tuesday. Even before the stock market took a dive, the board was expected to stand pat on rates this week, with as many as 4 more rate hikes coming later this year. Now forecasters are saying 2 to 3 rate hikes may be more accurate, something we at Carty & Company have been telling clients all along. With the global markets weakening, European Central Bank President Mario Draghi warned on Thursday that downside risks have increased. But how much attention should the Fed pay to market jitters? If they pay too much attention, they run the risk of validating expectations in futures markets. Too little, and they may have to move more aggressively if the economy ends up gaining speed. In fixed income, volatility in the Treasury market jumped to the highest level in nearly 4 months amid wild swings in the global financial markets. The 10-year Treasury has rallied to the 2% support level. This is the 4th time since August the 10-year has tested this level of support. It has rebounded from this level 3 times in 5 months, and with all this market volatility, it'll be interesting to see if the rally continues, or if it bounces for a 4th time. Bank of America Merrill Lynch says the default rate in high-yield markets was just 1.82%. That's much lower than the long-term default average of 3.77%. But the level of spreads implies a default rate of around 6.5%, much higher than the average. This suggests that investors are currently overcompensated for the level of risk that they're exposed to. U.S. stocks got some relief to close out the week. The 3 major indices saw the strongest 2-day rally since mid-December. Valero led the way in energy, gaining about 5%. Technology shares pitched in as well, adding just under 2.5%, with Apple leading the way with a 5% gain on the week. On the downside in financials, American Express slumped 12% after reporting a 38% drop in quarterly earnings. This is the company's biggest quarterly drop since 2009. Some analysts are blaming the recent stock market volatility on short-run concerns about earnings. The 20% decline in crude oil prices so far in 2016 isn't helping any. The energy sector contributed to about 5% of the S&P's earnings per share last year. Some economists say that energy's contributions to earnings in 2016 could drop to as low as 3%. That sums up your weekly market update ending the 4th Friday of January 2016. For more details, please visit our information center at www.cartyco.com, and for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching, and have a great week.